what if people are not asking about the reviews or not asking about these policies that are on the books?
Well, honestly, I think if you have a fiduciary duty to your client, you are not living up to it. And you are certainly not covered from a compliance standpoint if an audit came down around or something worse.
Hey there, welcome to CBS Spotlight. If you are here by mistake, you are in the right place now. This is the podcast that's all about the often forgotten insurance toolbox and how it's there to support you, the advisor, and the RIA in building and protecting your clients and their legacies. I am Michael Corman, and I am with the one and only Eric Alvarado.
Hello, everyone. Glad to be here.
And we are your friendly guides through this world of insurance and wealth management. Eric and I are both senior marketing directors at CBS Brokerage, a boutique independent insurance brokerage general agency, and our job is to teach, live, and breathe all things risk management for our offices and clients. We have both sat on your side of the table, being responsible for client plans, knowing you're the first person they call after a family or life event happens. This podcast, we are going to have some great conversations about how insurance can be a powerful tool in your toolbox, enhancing your ability to provide comprehensive financial solutions for your clients. And twice a month, we are going to kick open that toolbox and pick a tool, aka a concept, and discuss it in detail. We tend to be afraid of the unknowns, so let's kick open that toolbox and play with some tools, because the more knowledge we have equals less fear of the unknown.
Absolutely. It's going to be a great time.
Oh yeah. That being said, let's dive into our first topic, foundational information, because we all need a good foundation.
You've mentioned foundational information as a beginning topic, but what do you mean when you say that? What is that? What are you talking about, Michael?
Yeah, no, that's a good point. So I like to lay down some ground rules. Jack Elder, our attorney, said it is never assume that someone else has the same knowledge or experience that you do. Start with some basic building blocks and then progress from there. You have to make sure you're on that same page. Otherwise, communication's going to get rough really fast.
Okay. So what I'm hearing is that, just going over the basic facts or principles first, so you are both on the same page, and then you go from there?
Yeah, no, bingo, you got it.
Okay, awesome. Well, can you give me a for instance then? Because, I'm starting to get the concept, but what examples do you have for me?
Yeah, no, I have a bunch, but I bet you do too. Let's go with one of the most popular ones though. So LTC, or long-term care, that is not to be confused with license to carry. I had both licenses at one point in the fine state of Texas here. So yeah, but long-term care is a legal term used by the IRS to describe a product that offers long-term care insurance and accelerated death benefits paid under a life insurance contract or paid under a viatical settlement provider. That is not to be confused with chronic illness or terminal illness. They're very different things.
Okay, so LTC, chronic illness, and terminal illness are not the same.
Correct. You are spot on. Chronic illness describes an individual as someone who has been certified by a licensed healthcare provider as someone who is unable to perform 2 of the 6 activities of daily living, that's the ADLs, for at least 90 days, or requires substantial supervision due to severe cognitive impairments. And the big issue is if you live through that first year, you have to get that certification done annually, which is a high bar to go over. And terminal illness is even more specific because it refers to someone who has been certified by a physician as someone having an illness or condition that's reasonably expected to result in death within 24 months or less. That's an even higher bar to get by.
So starts broad and gets more and more and more narrow. So you said ADLs, activities of daily living. And what are those? Why are they so important?
Ooh, okay, that's a great question. Is activities of daily living, or the ADLs, as you said, are what carriers and doctors use to help understand the level of care an individual needs. So I think of it as what you do when you first wake up. So that's transferring, toileting, bathing, getting dressed, eating, and continence, holding it all together while you're doing all of that. And two of those are triggers for a long-term care event. Or if there's a cognitive impairment, that alone is a standalone event. So that's either two activities of daily living or a cognitive impairment, not both.
Well, very good information to know. So what about traditional LTC versus, say, hybrid LTC? What's that?
Ooh, yeah, no, that's a big one. Okay, so traditional LTC, or long-term care, is what it sounds like. For example, traditionally, when you buy homeowners insurance, you don't complain when your home doesn't burn down. So traditional LTC is that, for lack of a better term, use it or lose it style, is if you pass without needing it, you lose those premium dollars. But that being said, you do get to, it's still a good policy, and it allows you to leverage more than you would be able to on your own. Because remember, you're not self-insuring, you're self-funding if you're doing it on your own. You're not mitigating that risk onto anyone else. So you do lose the chance of those premium dollars if you end up living a long life and being healthy and not using it. But that being said, though, hybrid, though, it's not your grandparents' long-term care. These policies are built on a life insurance or annuity style chassis, if it were, depending on the structure of that policy and how it's paid, whether it's qualified or non-qualified, which, yeah, you can do some of these long-term care hybrid policies with qualified money. It's very interesting. But we talk about that. We'll talk about those details in a different show and get into that later. But how hybrid LTC works is when you pay, you get access to a pool of benefits, of benefit dollars, and that pool of benefits is used for LTC expenses in life rather than a death benefit. So you don't have to use all of those benefits. You can use a portion of that pooled benefit and it goes on. And if you don't use those benefits at all, they can move on, they can pass on to your beneficiaries in the form of a tax-free death benefit. So worst case scenario, you need coverage and you're able to leverage a lot more money than you'd be able to on your own. Or the money that you have, it's not wasted and it's done as a tax wash, moving from one pocket to the other, because your beneficiaries get it in the form of a tax-free death benefit. And the other thing is, these policies can be joint policies, so it can work for both spouses.
Yowzas. Well, that is a huge difference.
Without a doubt. But what about you, Eric? Throw me some foundational knowledge. What's something I should know?
Well, how about the types of life insurance and why they're used? Something kind of high level.
Ooh, yes, enlighten me.
Well, all right. You got your basics of life insurance, right? You got your term, you have UL or universal life, IUL or indexed universal life, your GUL, which is guaranteed universal life, and also whole life.
Okay, cool. Why might someone use one of those over the others? Because that's a lot of different UL combinations, and why are there so many types of universal combinations?
Very good question. First of all, I think insurance actuaries probably just aren't creative. They just don't know how to name those policies. But term is term. It has no cash value. It keeps costs down and is fixed for a set number of years. And really, it's probably the simplest form of life insurance. I mean, most people can get group life insurance through their employer.
So ask your employer about your benefits for sure. But what about universal life policies and whole life?
Well, life insurance through your employer is usually the cheapest way to get group life insurance. But if you leave or lose your job, that coverage goes away as well. So something to keep in mind. Universal life is generally designed to accumulate cash value, not only in addition to just being a death benefit. So this is done in a number of different ways. But for example, index universal life is a policy whose cash value participates in the market via fund or funds that you can pick or participate in. Your cash value is indexed to the market. A GUL, on the other hand, is a guaranteed universal life contract, and it has a guaranteed death benefit, but you're not going to find any cash value in there. And this is done really to keep the premium costs as low as possible. You get the death benefit, just not the access to the cash value in the life insurance. So now whole life, on the other hand, is designed more to not only accumulate cash value, grow, and have a death benefit. And so, with these things and most things in life, added features come, of course, with added cost, right? So.
Okay. So each policy design has a type that does something different and is meant to provide a unique benefit for that client's specific needs.
Yeah, absolutely. Spot on.
Okay, so what about the policies we didn't sell or our clients already own? How should those be handled? I feel like this is a question that doesn't come up near enough.
Absolutely. I mean, policy review is important. And whether you like it or not, clients are already going to own these types of policies, whether it's life, annuities, LTC, et cetera. It needs to be a muscle memory for those types of annual meetings. I mean, asking for a copy of the policy, the in-force illustration also needs to be attached to be able to be reviewed.
Okay, so what if people are not asking about the reviews or not asking about these policies that are on the books?
Well, honestly, I mean, I think if you have a fiduciary duty to your client, you are not living up to it. And you are certainly not covered from a compliance standpoint if an audit came down around or something worse.
Wait, you mean something worse than an audit?
I've seen this case. Client buys LTC coverage, in the 80s. And as time goes by, policy's not reviewed. Premiums increase multiple times over the years, and the client ends up dropping the policy, right? Because they just can't afford the rising premium costs. Well, years later, of course, spouse has a stroke and requires a lot of medical attention. Well, medical costs get out of control. Client spends all of their money on care. Kids start trying to help out, and they start asking questions. And then it comes to their attention that their parents let their LTC policy go. And why? It's because the advisor didn't review it or talk about that LTC coverage. So the kids sued, the advisor for the breach of fiduciary care. And then the parents, might have kept or gotten different coverage and been more financially protected if that LTC policy had at least been reviewed or at least discussed.
Whoa. Okay, that escalated quickly. So at bare minimum, we got to get that muscle memory going and asking, like, if those policies are on the books, can we look at them so we can review them? And then, so once we get that, to make sure that the client's needs are still being met. And correct me if I'm wrong, I see this going as one of three ways: either all good, need to make some adjustments, or exchange it and or let the policy go. Is that right?
Yeah, you got it. I mean, the review helps the client by making sure that their needs are still being met and protects you from a compliance stance. So whatever adjustments need to be made, they're made. So at least they're being addressed.
Awesome. I like it. On that solid note, I'd like to say let's wrap it up for our first podcast on CBS Spotlight. Thanks, Eric.